What's going on, guys? Bexio back, and today we got a brand new video with the housing market because we know real estate is the slowest moving market and can have effects on how things like the stock market go, and showing maybe how the economy is working too. So, right now it's definitely in a tougher spot with interest rates going up, making mortgages more expensive, forcing prices to go down in theory, but we aren't really seeing the prices move down. But it's also a super slow moving market. The real estate market moves probably within 3 to 4 months behind interest rate moves. So obviously, people who were buying houses 3, 4 months ago are locked in at the lower rates, and people who are buying houses now will be locked in at newer rates and will show up in data from a couple months from now. So it's very slow moving compared to something like the stock market, which reacts instantly to any news that comes out. And we can see a lot of different information coming out on the housing market. And one big chart would be this right here, the saying right here from the Wall Street Journal, saying house poor. So this is the median mortgage application payments jumped to just over 1,700 in March as both home prices and interest rates rose. So you can see the national median mortgage payment, a massive jump here to almost $1,800 per month. And that jump is because of interest rates going up and prices sustaining where they are or even going up even further. So maybe we see this inflection point in a couple months where it comes down, where prices come down, but we're also not really, maybe not even going to see that. Where if the inventory stays kind of more scarce and there's not a ton of sellers, then the buyer stays the same. Then we could see or prices continue to just keep moving up. So this massively just insane sharp move up. You can see this goes to 2015. We don't see sharp moves like this for the last 7 years, and right now we're seeing it. And a kind of funny thing here is Michael Saylor's response, saying it looks like a 45% increase in monthly cost of housing in 2 years, or an inflation rate of 20% for first-time home buyers since March 2020. So if you're a first-time home buyer, if you're any home buyer, the inflation of housing is up 20%. Well, CPI sits at 8.5%. So you can see real inflation is hitting hard in a lot of areas. So housing gets hit really hard. If the housing market starts to fall, maybe that's what forces the hand of the Fed to actually move out and make changes and lower interest rates again, or try and flood the system with money and stop things from getting worse. Because we know when the housing market falls, it affects everything and everything gets worse. And one of the reasons is people who have houses, especially if you're buying now and then you go underwater on your mortgage, that's terrible. But if you have a house, and even if you own it outright or you have a mortgage and you've had it for a couple years, this increase in value brings to you a lot of value, where you feel richer, you start spending money more. You just have a wealth effect where you feel like you have more money, even though it's on paper. But it feels good to have that more money. So when prices go down, even if you still up before you bought it, or up on your mortgage, or up even if you own it outright, you're still technically up. The wealth effect goes away very fast. If you lose $50,000 off your house value, people feel that if you're keeping up with it, and you stop spending so much, you stop going out so much, you really stop spending money, then the economy really suffers. And that's where the real estate market comes in, to even the stock market and all the other markets, with the wealth effect. When people's houses are worth more, when housing's going up, it feels good. People spend money, they feel like they have more money, because technically they do, even though it's just on paper. But when it stops going up and starts going down, then you have bigger problems, where the economy, which is already in a tough spot right now, comes screeching to a halt. And if we want to compare the US to other countries, it's not actually that bad. And we can see it right here, saying at least we aren't Canada, saying real home prices versus real disposable income. And this goes all the way back. So if you look at home prices, which is the red line, you can see this is basically 2008, the financial crisis, the housing bubble, everything. And we're above those levels. So that might not be good already, but it's also just crossing disposable income again. If we look back, though, we did cross it. It lasted for probably another year, or year and a half, 2 years before finally coming down. So, I mean, maybe these ridiculous prices can still go up and still go up for a year after this stuff. But uh, if we go back to the past, we're above 2008 levels. So who knows what's actually heading. But if we look at Canada, I mean, it's not even close. Home prices have just skyrocketed and incomes have not. So something to maybe this is something that can happen, especially if the Fed comes back in to bail everything out. Home prices shoot up to the moon while incomes don't necessarily do the same thing. And this right here is from Redfin. So they're in real estate like agency. They sell houses. They do all of that, kind of like a Zillow. But they have right here record share of home sellers have dropped prices, but buyers are still struggling. So that's the recent news. Big thing here. Number of home sellers who dropped their asking price shot up to a 6-month high of 15% during a 4-week period ending on May 1st. So just showing, there are people dropping prices. Prices are already dropping. The data is going to lag from looking at housing market and reactions to interest rates, but we're seeing it right now. Housing prices are dropping at a 6-month high rate. And we have why are prices still high? Supply continues to lag far behind demand as buyers continue to outnumber sellers. So the typical home flies off the market at the fastest pace on record and for more than its asking price, Redfin reported. So even though we have 15%, we have these high numbers shooting up of dropping prices. It's still a supply and demand problem where there is not enough supply. There is way more demand for houses, and the houses just aren't on the market. So there's going to be a lot of demand, a lot of competition for houses, then bidding them up above asking price. So even if asking prices dropped, sellers who drop their asking price, if people are coming in and want that property, they can bid it up. And then even if you dropped it, you attract more people and they bid it up and it sells for above asking. It's a possibility. So, just easy, normal supply and demand stuff. And then the numbers, the median home sale price was up 17% year over year in the 4-week period ending in May. Biggest increase since August to a record $396,125. Median home sales, almost $400,000 for the median home. That's crazy. That's a huge just number for a median number across the country. I mean, you take into account places in the Midwest where houses are going to be super cheap. And then obviously California, New York, big cities, those are going to bring the housing price up. But it's crazy. A median price for a house is $400,000. That's ridiculous. How many people can actually afford that? How sustainable is it? Kind of just ridiculous numbers. And we see pending home sales down 4% year over year. So maybe the demand's kind of tapering off a little bit because of the interest rate hikes. Obviously, if the $400,000 house is the median price and interest rates are going up, that means even for the same house, the payment goes up probably a substantial amount. So you cannot afford to buy the same house you were looking at, even though it's the same price, because the interest rates have gone up. So demand could taper because of that. And then new listings for home sales are also down 6% year over year. So demand going down, but supply going down faster than that. So still, the supply and demand stuff getting insanely crazy. Active listings, or the number of homes listed for sale at any point during the 4-week period ending in May, fell 18% year over year, even though spring is supposed to be the busiest time for home buying. So homes listed for sale down 18%. Again, supply still not coming to the market for whatever reason. And it's down 18% in the springtime. And the springtime is a big time for selling houses, great for real estate, spring leading to summer, kind of shopping for real estate, selling real estate. It's good times for that. Coming out of the winter, which the winter is the slow time. So to see it falling still, it makes you wonder, like, people might be looking at these interest rates, looking at everything going on, just saying, I'm not going to sell, not in this environment, don't want to be involved in it, don't want to have to shop for another house in this environment. And then here we can see the monthly mortgage payment for median asking price home also rose to a record high $2,400 at a current 5.27% mortgage rate. Crazy. So, and then you just compare that to a year earlier, 1688 a year earlier when mortgage rates were below 3%. So, this is how interest rates affect the mortgage rates and the pricing of homes and how people feel buying a house. So, the same house you're looking at could have cost you just under $1,700 for the same exact house, and nothing changes except interest rates. And now your bill goes to $2,400 a month strictly because the interest rate's higher. Nothing about the house changes. So that tapers demand pretty hard. And we are seeing that just prices are getting higher and higher and higher. And it's just pricing people out of the market and pricing sellers don't want to sell because they don't want to have to pay 2,400 for a mortgage when they have one locked in at 1,600. Why would anyone do that? So demand can go down, but supply is going down as well. So it's kind of just a double-edged sword at this point. And just a last chart to look at, just to kind of see how much people are saving and spending and how bad things might actually be getting. As you can see, your personal savings rate collapsing while piling back into record credit card debt with 40-year high inflations. This is not a good sign. So blue is credit card debt, red is savings rates. And you can see an explosion here and here. These are stimulus times when the rates are so high. And then the debt goes down, stimulus times, paying off debt, and everything is good. And now we see saving rates plummet even lower than where they were before 2020. And now debt, credit card debt, skyrocketing almost higher than it was in 2020. So a lot of problems here. Mortgage rates going up, credit card debt going up, personal saving going down. It's just everything adding up for a not so good economic time, and where inflation's super bad, interest rates are going to get worse because they got to price them up to fight inflation. They got all these problems. Money printing didn't help when that happened. So there's just so much going on, and it's not really looking good from all the data that we can see. So the housing market is ultimately extremely confusing, but probably heading down in the near term future, at least heading out to the end of this year and maybe even beginning of next year, where the housing market might start to recover a little bit. If it does go down, it'll go down into this year, maybe beginning of next year, and then the mid of next year, maybe we can try and see for hoping a recovery in housing market. We don't want to see housing just collapse. A lot of people say they might want to see that so they can afford a house finally, but if housing collapses, a lot more problems come along with it. So all the data we got, it's not looking too hot for at least the majority of this year, and we'll see how it all plays out. And this all plays into the stock market that relies on economic activity, obviously companies selling their products to people, and if people can't buy them or don't feel like they can buy them, then there's a problem for those companies on earnings reports. So a lot of things ties in together, but that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next